Hear me well. Please, somebody tell me if the stream is up. Such a tough week, but very productive. So I hope you see it. Let me just maybe double check myself. Yeah, beautiful. Mr. Aliki, thank you so much. Really appreciate it. Okay. How many people are watching us? Any idea? Today, actually, pretty. I mean, the more this thing is being shaped, the more I'm personally ecstatic about like how amazing it could really be. But it won't be amazing unless we all understand how it works and all participate. And by us, I mean Wales, council members, ghosties in general. Um, what I'm realizing is the, the tech, uh, what will make, so we all got into, not all, but most of us, or the Web3 believers, at least I think, got into the space because we are trying to really formulate a proper digital economy. Like when people say, "Oh, let's like shape the digital economy," like there are different nuances on like USDC Circle is shaping digital economy, right? Because it's digital, right? Like and it's connected to economy, so it's a digital economy. Um, that's not what crypto is. Crypto is not a widget that just attached to like a attached to an existing process. Digital economy means that the entire economy is digital. The whole thing, it's a wholesome product. Uh, some people, well, many people love Harry Potter, and like I kind of fell in love with it too. And the reason why is before I was thinking just a fairy tale, but then the amount of detail that J.K. Rowling put into creating a world, like the entire wholesome world. Same thing applies to the Lord of the Rings, right? Tolkien, same thing. Like it's not about it's like like the magical forest or the Gandalf. Like it's the entire different world with lots of details. And what we're all excited about is how thought through these details are. So it was like the entire different universe, fully thought through, not just a freaking like 10% surface type of thing. No, whole thing to the detail. Like for example, in Harry Potter in particular, the Harry Potter world has its own fairy tales in it, right? Like it's crazy, like crazy amount of like has its own type of celebrities, right? Like it's like the whole thing thought through. And when we're talking about Circle, for example, Tether, what the hell do they do? Oh, we're just creating Tether. Like that's a product. It's exciting, yeah. It's definitely useful. I mean, for now, at least to some people, to many people. But for example, MakerDAO is so much more wholesome because it does not require any sexes. Didn't require at least. No sexes, no KYC, nothing. Like you have Ethereum chain maintained by validators of Ethereum. And with MakerDAO, all you can do is you can convert your ETH into DAI on chain. Why would you need that? Well, for example, what if you want to get out of ETH because you think ETH is going to drop? So, like, you can go long ETH, but how can you go short ETH? Well, you can't. But what you could do, you can cash out of ETH. When you do that, you're not effectively shorting it. You're not making money on the short, but you sold ETH, and you can do this thing on chain, right? So without MakerDAO, you would not be able to get your exposure to a stable asset elsewhere. Well, I mean, obviously you can do this with Tether and Circle, but I mean on chain, completely on chain. like with no referrers to anything. And even DAI to some extent is somewhat hybrid because DAI has to be referred to the current level of USD. So therefore, Maker exists to some extent when the level of ETH to USD is known. That's very important, right? So like, let's assume there's no SEC, there's no Kraken, there's no Coinbase, there's nothing. What's the price of ETH? We don't know. The price discovery of ETH happens on these centralized exchanges, right? So we know that ETH today is, let's assume, $1,500, $1,600 per ETH, right? So we know that. And then Maker would then kind of like confirm with the SEC that if that's the price, and if that's the price, then they would properly allocate the required collaterals needed. So even Maker, to some extent is referring to the outside world. Circle is completely referring to the outside world. Circle is a freaking wrapper, like a Web3 wrapper on a Web2 thing. It's same thing with Tether. Such a long intro. Why? What makes Olympus DAO so interesting is Olympus DAO is a completely new universe. Like, it's a wholesome play. It has its connections as well to the dollar because it is kind of the idea of Olympus. Now they completely erased it, and they completely erased it everywhere to potentially not get into any legal issues. But in the case of Olympus, you had to like make Olympus an alternative reserve currency, thus it's pegged to a dollar at the end. It's trading way above a dollar, but the idea was that it would be pegged to a dollar. So the dollar is a floor. It does not mean that the dollar is a floor. It means that the value should be a dollar. And they include everywhere in all of these in all of their formulas, they do incorporate that notion. It's very important how they incorporate it. Like, they incorporate it at the very, very core, to the point where this formula that you guys see on the screen now, back in per Fatso, right? Let me just like show it, which is egos, right? So this formula is completely based on the notion that like 1 ohm, 1 egos, 1 Fatso should be a dollar. Today it trades at $1,500, but it should be a dollar. Now, with this notion, even Olympus, with all our massive respect to the project, this is why this week was very tough and very productive. We dived deep into the formulas. And you would think that Olympus has lots of resources online explaining exactly how it works, and it doesn't. You would think that SushiSwap and Uniswap have all the resources in the world to exactly explain how it works, and they don't. On Olympus in particular, at best, and trust me, guys, like, it was all-nighters. All-nighters. It was not just like, oh, we just do some, it was all-nighters, the whole week. And the idea is to try to, as we get closer to certain things, try to iron it out. Because what makes Ghost and any successful Web3 project unique is not just tech. Tech is a part of it. Tech and game theory, including tokenomics, is a significant part. Without that, there's nothing. So you have some projects that just like, say, Hyperledger. Like, why these other projects died? Hyperledger by IBM. They wanted to, created this, like, whatever, centralized, decentralized, whatever. We call it CRM on crack type of system. They still have some validators, but there's no incentive for validators to validate. The system doesn't work. It's not a blockchain. So you force users, you force machines to validate, but there's no incentive. So therefore, there's no incentive to be a good actor. So you can just manipulate the data. So that's why these projects failed completely. Same thing with R3. They called themselves DLT, Distributed Ledger Technology, right? They officially approved it like back in 2018, 2019. Are they bankrupt now or not? Whatnot, right? So the tech itself is important, but it's not it. Tokenomics, I can't say it's 90% of the project was success, but it's a significant portion. And we had some discussions with one of the council members. Um, yeah, he has some connections, some access to some development talent. And like somebody created this, Bitcoin bridge, and let's try to integrate it with Ghost. Um, Great, that's all great. At the best, at the very best, that's like maybe 10% of the problem, maybe 5%. Because the tech itself, first of all, the tech is difficult to build. Absolutely true. But once you build the tech, integrating it with the stack, blah, 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 okay, that's still part of the tech. Okay, fine. But then tokenomics. How to make sure that people, users, are entities, are incentivized to um, operate through the bridge, for example, right? Or incentivized to participate with the ghost. Like, that's so damn important. And it's not trivial at all. And we do not have all the answers. That all comes out together with the community as we move forward. So there's definitely some general direction, but we don't know exactly where it's going to lead us. Very similar to, say, central banking. Right? Central banks, say Federal Reserve, have monetary policy and fiscal policy. So, there's a way to issue bonds. And when the bonds are issued to the public, what happens is these bonds are issued by the Federal Reserve entities such as mostly investment banks who have direct connections, who are essentially dedicated to purchasing these bonds. Now they purchase the bonds. What happens is I'm Goldman Sachs, I'm spending money to purchase a bond from a central bank. When I purchase the bond, I spend cash. So in order for me to pay cash to the, in exchange for receiving the bond at an interest, I have to spend my money, and therefore I'm moving money outside of the monetary circulating supply. So let's assume a bond is worth $1 million. I'm Goldman Sachs. I just paid $1 million for that bond. So effectively, now you would argue, well, the $1 million still exists with this Federal Reserve, but that's considered to be burned. So essentially, when you send that, when Goldman Sachs sends $1 million to the Federal Reserve is kind of burning it. So now your circulating supply of dollars just got diluted by diminished by $1 million, right? So effectively, through these fiscal monetary policies, well, mostly fiscal policies, actually no, monetary policies, you can control the supply of cash, and by controlling the supply of cash, you can then control the inflation. Well, kind of, right? Although some economists would disagree because they measure the inflation differently. But effectively, inflation is just some other economists, especially Austrian economists, they just say that inflation is just the increase in the supply of money, right? While inflation in reality is something different, right? Because it also depends on the amount of labor and services produced per dollar, right? So it's like more complex. But if it's just being simple, we can just say, hey, like if today we had $1 billion and tomorrow we have $2 billion, then the inflation is 100% because this monetary supply went up by 100%. It's not exactly true because what if the amount of services, products and services increased by 200%? Then you actually have deflation potentially, right? So it all has to be taken into consideration. But in short, when we know the GDP is growing, say, by 3%, officially, and the monetary supply grows by 7%, then we know the chances of inflation is 4%, right? We can pencil it out. So again, this other long segue, why? Central banks' fiscal policies are known. So we know what to do. We know that we need to issue bonds or buy the bonds back. And thus we will be controlling the monetary supply. But then the question is, how many bonds should we issue? What's the answer to that? Right? So we know the mechanics, but what's the actual coefficients? Like how many bonds should we issue today? To do what? What's the goal? Right? So the tech will be responsible for programmatically managing these functions. The tokenomics will be responsible for understanding the mechanics of what needs to be programmed to some extent. But then the common sense and deep dive into how these things work will define what do we do today. People say, oh, AI will change the world. AI will change. Like, guys, like if people are like quick short circuit. Devs taught me at work today, short circuit, like when the loop breaks. So like when AI disincentivizes creation of new content, that's it. When people don't want to create new content because all the content writers have been fired, AI will be only trained on the same exact articles. So it will not be updating itself. Period. That's it. AI is done. Right? So the tech is stupid. Like all these bullshit freaking, oh, AI will change the world, AI will be here, like it's all bullshit. How do we know? We wrote 3 academic research papers on AI. So we know that it's bullshit. It's powerful, it's a tool, but blockchain, Web3 is the stuff that is getting regulated globally. That's the important thing. And it's not just the tech and it's not just the tokenomics, it's also understanding by all the actors, all the users, all the whales, all the council members, how this thing works. And it's not trivial. And even when they understand the mechanics, making decisions on the spot could be super costly. So we need to understand how these decisions need to be made. And the only way to properly understand it all is to play with the existing products. That's the only freaking way. That's very important. And that's why we're doing spending so much time on the testing. That's why we are delaying the mainnet for such a long time. Initially, because we just building community. Now we're building community plus, trying to educate the audience how exactly this thing works. And there are no specific instructions. You have to just mess with it. You have to get your hands dirty, play with it, make mistakes, lose testnet tokens, gain testnet tokens, and then understand how it works, and then ask questions to yourself. You don't know all the answers, to yourself. So let me just like give you an idea of how Olympus. Any questions at this point? Like before oh, maybe we did have some questions. Lorenzo, good morning. Zafira, which paper confirm your views on AI out of interest? Which views on AI, Zafira? So the views on AI regarding the local minimum, you can just Google up local minimum on artificial intelligence and you'll understand what I'm referring to. AI is not AGI is OBS. AI has to be trained on, it cannot be just straight on whether something has been like, AI has to have a goal in mind. The goal in mind has to be measured. So therefore it has to receive constant constant feedback, positive and negative, regarding do they do a job well or not. So that's the first thing. In order for you to measure how well you do it, you need to have comparables. If you don't have new comparables, you out. Right. So like in case of even like in the easy example of the articles, right? So you have the existing articles and AI is doing a good job rewriting articles based on the existing articles. Cool. But if you do not produce new articles with new information, it will be impossible to benchmark against whether AI is doing a good job or not. So you will lose that specific feedback cycle that is needed for AI to train. So therefore, you will need to produce more content. But if you fire all content writers, there's nothing to compare AI to. So you just lost it, right? So like that's just the nature based on the Murphy's law. That's just the nature of any tech. The tech that is just like all programmatic is not going to survive because it's only going to be overcomplicating the system for no reason, right? Creating like Murphy's law goes like this: if there's a problem and the problem can be solved with tech, when you solve the problem with the problem one with the tech, problem two will appear, and then you will need to create another solution for problem number two, and then you'll need to create a problem number three created by solving problem number two, and so on. And so it's a never-ending cycle. With blockchain, the interesting thing is it's not all tech. Like people say, Bitcoin is programmatic. No, it's not. It is, but it's not. Like it's not all programmatic. The beautiful thing about Bitcoin or any other Web3 is that it has tremendous amount of human element based on game theory. And game theory is possible due to genius tokenomics. But tokenomics does not work programmatically. I mean, it does, executes programmatically, but it does not work. It is not created programmatically. Satoshi would not know that Bitcoin would be trading at $80,000. In fact, he would probably be voting against it because the fees are so expensive. It's becoming unmanageable. Now the fees are lower because of the Lightning Network. I don't think Satoshi would think about the Lightning Network originally. So, therefore, like what makes Bitcoin so cool, so unique, just like some other Web3 projects, pure Web3 projects, is users use the new world mechanics created by this project and they participate in it. And then they try to break the rules, they try to abuse the honeypot slash loopholes. And when abusing it, they only help strengthen the network more. AKA abusing, AKA is acting in their self interest, right? That's what it means. So Zephyr is asking, what's my personal view on AI in 3 years? I have a lot of things to cover. That's a great question. Let's cover it soon, maybe in Wales. But we have so many things to cover today. You guys will be just blown away. Trust me on this. We'll start with the formulas that you guys need to. What I'm trying to prep you guys to is we got to present some formulas, but understanding these formulas is not enough. We also need to test them. And building simulations for all of them is virtually impossible because the number of scenarios for these simulations is just unlimited, literally unlimited. Just like, here's a piano. There's 7 notes. Let's create all possible simulations for all the possible music. That's impossible, right? How many different songs potentially can be created if you just do the combinatorics analysis of all the combinations of all these notes in different order? The entire show business will be collapsed, right? Like if there's a possibility to create all the songs and patent them all, like it's impossible, right? Like same thing here. Like you should consider Goes Down as a tool set. You should understand every single note in that tool set. But then the amount of different melodies that can be created, and then you have a melody, fine. But then you can also add the acoustic guitar to it, like different accompany, right? Like, or let's add the drums. Let's add different drums. Oh, what style is it? Punk rock? Is it classical music? Like what is it? Right? Is it pop? Like is it rap? So it all has so many different variations to how we can compose it. And I'm not trying to overcomplicate it. I'm just trying to explain exactly what it is. Meaning the formulas that will be presented, even if you understand them, it's not going to save you. It's not going to save us, right? It's a cumulative effort. We all have to understand where we're going with this. One thing I would like to prevent. So first of all, the new bond has been created. So guys, rush. Yesterday's bond got purchased out very fast. So yesterday's bond had a 97% discount. This one has an 87% discount. Widescreen. If somebody from the dev team is watching, please fix it for bond number 2, the widescreen again, maybe error treatment. Let me go back. So we need to fix this and re-upload. Let me try Shift F5. Maybe it has been fixed already, by the way. Maybe I just didn't update it. 1 second. Oh, it is working. Guys, sorry, I think it's working. I just didn't do Shift F5. Sorry. Okay, so we have 87% discount. What's that discount? This discount is 200 GDAI. That's the price of the bond versus the market price of $1,500, which presents an 87% discount. Why was it set at $200? First of all, these bonds will have to be created by a multi-sig. Multi-sig means the team cannot be creating it. It has to be a multi-sig comprised of ghost holders. Maybe that's going to be council. Maybe that's going to be most likely validators who will be part of the original multi-sig. I don't know. Maybe it's going to be, I don't know how to structure this yet. We don't know. We need to discuss it. Ideally, the more the better. The more decentralized, the better. But also not more decentralized than needed because the bonds need to be decided fast. Because we need to think about this Ghost DAO, rather Olympus DAO, but Ghost DAO. As a new universe, it's a decentralized central bank with this freaking policy, monetary policy. And then you have different objectives. And I want to ensure that the objectives are super much in line with what we have as a goal. And with Olympus, this is the result. Now, it's not fair to say the price dropped. That's why it was unsuccessful because the price dropped even now to $22. That's a 20x upside. Show me a project that is 20x because it started at $1. But you shouldn't be looking at this from the price perspective. You should be looking at this from the market cap perspective. Which obviously CoinGecko is not freaking working because, happy Easter, everybody who is celebrating happy holidays. Because, CoinGecko decided to take Easter holidays, and so did Sepolia. Sepolia, Etherscan did not work for 3 days because servers that are managed by AI, obviously, decided to take a freaking, with all due respect, Easter break. I mean, I have nothing. I respect the holiday so much. I completely demolish this bullshit. We AI and machines will take over the world. Fix the fucking website. Can you make it work? It doesn't, right? So that's just the nature of it. But the market cap is way better than the price. Like even if you look at the price, though, it's not as bad. It looks bad, but it's not as bad. However, one thing that I think was wrong with Olympus, like it's so non-humble for me to ever say that, by the way. But we need to, like, my goal is not to criticize. My goal is to like paraphrase. Like my goal is to, what is a different objective? Olympus did what they did for multiple reasons. They probably did the most rational decisions at the moment. The moment when they launched 2021 was lots of farming, lots of staking, lots of bullshit APYs, like 100% APY, 200% APY. And Olympus went out with 10,000% APY, right? If you guys remember, or 5,000%, some crazy APY number, because they were trying to compete with all the other farming and staking protocols. And of course, that was quite attention capturing. However, we don't have to go with 10,000% APY. We can go with 100% APY. We can go with 50%. We can go even potentially with 30% APY and thus ensure a more long-term growth without such spikes. That was one thing that they've done. Another objective they've done is they always, and they sold it as we are an alternative, essentially stablecoin, right? Reserve currency. And they're pegged to $1. I mentioned this in the beginning, and they do have this in their formulas, like deep ingrained in the formulas, the dollar price. It's deeply freaking ingrained. And while they are trading at $20, right? By the way, they raised this whole message of reserve currency, probably due to certain restrictions or possible restrictions on anybody who claims themselves, any project that claims themselves to be an algorithmic stablecoin that came out of Europe/US. So maybe that's why they did it. But even at $22, they're super close to $1. I think what really happened when these prices went up, I think the objective was not clearly stated. They didn't know that the project would shut up that highly that fast. They didn't know what to do. They probably cashed out. Some investors also cashed out at the top, and boom. I wouldn't say that all the retail investors got what's the word? Got penalized for holding it or lost all their money. We actually don't even hear those feedbacks much from Olympus. Lots of people made the money. In fact, lots of users, I'm pretty sure, were selling out here, making money in the green. However, they tried to peg to $1, and I think that was one of the reasons for this massive decline. So I think this, like, essentially massive APY. The massive APY would lead to huge index. For us, it's 4.84 right now, which is already pretty high. Should be lower. And this index, by the way, is to some extent potentially erroneous. So we need to look into it. Like, why is it so high? Because our APY is much lower. It's 69% as of today, so it should not be increasing that much. So we still need to investigate what happened here, and that's why same difference between circulating and total. Total should always be greater than circulating. So why did this happen? Based on the code, everything worked exactly how it's supposed to work, but there have been some issues with the rebase, so we need to look into this and understand exactly what's working. But our index is supposed to be, at this point of time, maybe 1.2, right? The reason why the index is important is because the index is the price between ratio of FATSA to Ghost. And if somebody got one Ghost at $1 today, this one and staked it immediately, that one Ghost would go to $7,500 per Ghost. So imagine that one person going now and selling this one Ghost that they purchased for $1. So they purchased for $1, selling for $7,500. That's fine, great APY for the user, but bad for Treasury. Very bad for Treasury. Right? Every single one share goes at 7,500. Of course, when they sell, it's probably going to be a little bit lower than 70 because there will be an impact on the DEX, negative impact on the DEX. So maybe they'll exit at $5,000 or $6,000 or maybe 7,000. Or maybe they'll exit, depending on the liquidity. If liquidity is high, they'll exit at that exact price. But that's detrimental to the Treasury because $1 of investment and $7,500 left from the Treasury. So this index needs to be potentially minimized, and it is minimized when the APY is smaller. If you need to attract lots of users and bring, say, 10,000% APY, because that's going to be our marketing gimmick, fine. But then notice that 10,000% APY will significantly, APY is the annual increase, annual inflation. It will significantly impact the index. Therefore, it will potentially be adding to the selling pressure of the treasury. And when it does, it results in these down spikes, right? So upside and massive decline, right? Demolition. Another thing is, I don't think we should be positioning this as a stable, like as a stable coin. Yes, we have a backend, but the backend at this point of time, after yesterday's bonds, is already $4. You guys need to jump on this bond, but do as you wish, right? Like, I would treat this not as a game. I would treat this as a real thing. This is today. These are the conditions, market conditions today. I have some ETH. Would I buy it? Maybe not. Maybe you say, listen, it's not enough. 87% discount is not enough for me. Why? Because I can stake ETH somewhere else. Or maybe I can buy the S&P 500 and earn my 12% annual. Last year I could have earned 30%. Gold is up 30% this year. Maybe let me buy gold. Or maybe you say, listen, like, I have some money that I want to do invest in crypto. So I'm gonna, 87% discount. What happens is I can purchase it now at 87% discount. So therefore, essentially what happens is I'm buying this at $200, right? Somebody just bought it and the price went up. So I can buy it at $200 and I can sell it within you're not going to get it today. You're going to get it vested within 5 days. And then you can go ahead and sell it on the on DEX for $1,500, thus capturing like 8x return within 5 days. Would you do it or not? Right? That's the question. Now, why are we doing these bonds? Because these bonds help increase the backend. And as they help increase the backend, so the difference between FATSO and backend is diminished. And that's what I think one of the metrics that we should all consider is the ratio of FATSO to backend. In fact, the backend is computed massively discounted. Massively discounted. So this is called RFV, risk-free value. This is, and I'll put some formulas. This is called market cap. And this value is massively discounted, and Olympus purposefully discounted massively. However, I don't think we should be discounting it because they've been discounting it on the premise that they are bonding this to $1. We shall not be necessarily doing it because we're not trying to be a freaking stablecoin. We're trying to be a bridge. We're trying to use Ghost as a bridging vehicle. So therefore, our goal potentially shall be increasing the treasury so much that when somebody wants to bond, there's enough treasury to minimize the slippage when people want to bridge from chain 1 to chain 2, chain A to chain B. Okay. So that's kind of what. So essentially, we can significantly. It seems like we can significantly avoid this downside. How? By controlling the upside. So if you control the upside, it happens, but it doesn't happen like a freaking like a match. It happens like very gradually, very gradually. Increases, and we are trying to disincentivize based on game theory, not based on any of the fucking like vesting schedule. Oh, your e-ghost is locked in forever, like for 5 years. None of this bullshit. None of this freaking like there's vesting for bonds, sure, but there's no vesting like for 2 years you cannot hold your token. None of this stuff. It has to be incentive based. Users need to know if they keep holding, it's going to increase. If they bring more people, it will increase for themselves too. Like all these referrals things, right? All these like buy and hold type of scenarios are built into the protocol on the programmatic level. On the programmatic level, as far as functionality, and also on the tokenomics level. However, in order for that to happen, to still make sense, our common sense, right, like our game theory as multi-sig founders of the bonds, for example, those who will be helping define the bonds, that should align with the final goal because we can only do so much, right? Tokenomics can only do so much by itself. Like we need to understand the tokenomics and then move in a coordinated fashion, in fully understandable fashion to get to the final destination, which I believe is much smoother growth, avoid volatility at any cost, the downside volatility at any cost, and just pro rata growth, right? So And there are different vehicles for that, and we're essentially discovering. That's why we did so many all-nighters, because we're discovering what this vehicle, what these mechanics, what these mechanisms are. Now, equations. So these are the equations from Olympus DAO. But here's the thing. You would think that Olympus DAO, again, I mentioned it, let me just do it one more time. You would think that Olympus DAO, such a huge project, went up to $4 billion in market cap. $4 billion with a B. Actually, like, absolutely real. Oh, here, now you can see it. Finally loaded. CoinGecko decided to take a break from Easter and fucking fix the website. So it went up to 4 billion. That's what we should be looking at. So the initial market cap has been 17 million or so, and now it is trading at almost 400 million. That's what we should be looking at. That's insane. That's the real metric. And it went up to 4 billion. Notice how there's only one spike in market cap and lots of spikes in price. And the reason why there have been 2 spikes in price and only 1 spike in market cap is because of the APY. APY has been absolutely massive. So we need to make sure that the market cap is steadily increasing. With rebase tokens, EGOS is a rebase token. We're not looking at the price of a token. We look at the market cap. Why? Because the quantity of EGOS is increasing. Therefore, the price of EGOS is being diluted by the increase in supply. However, the market cap stays the same, right? Like, because you increase the you increase the supply, you decrease the price, but when the product of them stays the same, right? That's called market cap. So we should be looking at the rebase tokens only at the market cap, and we should avoid the downsides in market cap, right? And we should encourage or incentivize slow, steady growth in market cap, thus preventing the declines. When you're looking for equations, every single source I found, every single source, there are only 3 good sources. Everything else is just some bullshit freaking articles that ChatGPT could have written, by the way, easily. Like, that's what they're good at, like writing some bullshit things. But anything in detail, every single article I found has mistakes, critical mistakes. These mistakes are actually super critical. Even formulas have mistakes, which is like bad. And the reason why that, like, the code doesn't have mistakes, that's such a huge, like, it seems like the developers had the scientific research paper that they formulated themselves. They wrote very good code. Code could be re-optimized, which the dev team re-optimizes significantly to minimize the fees. So we didn't fork it, we rewrote everything to that's huge kudos. However, when somebody was trying to describe the code through formulas, they made mistakes. So every single article has mistakes. There's one article that only has one tiny mistake. Everything else is great. And this person has been, to some extent, either later on or at the moment affiliated with the project. Even the documents of Olympus DAO equations here have mistakes. Bond price 1 plus premium, that's a mistake, because bond price just is equal to just premium. And then premium is equal to debt ratio times BCD. So this 1 plus sounds like nothing, but it's huge. It's a huge freaking error. Not only that, but when you are trying to figure out the RFV, which is the risk, like the backend, right? It's equal to treasury balance, stablecoin, and treasury balance of other assets. There's no formula for treasury balance of other assets, right? So you have treasury balance of the stablecoin, which is this and this, but you don't have this anywhere, and that's the most important, and that is right there. You see how they called it differently? Like, they called it treasury balance of other assets, but then here they called it RFV of LP bond. And if you don't know the formulas, which we're diving super deep into, you would not know the difference. Like, you would just like look at these formulas, they already make no fucking sense, right? Like, and then they even use different, like, see like how RFV LP bond here is also used here. So this formula is also mistaken, because a treasury balance of stablecoin is only equal to RFV of reserve bond. So whoever wrote these, and that's official docs. Imagine what happens in articles covering Olympus DAO if they made mistakes. I wouldn't say that this negatively reflects on Olympus DAO per se. I would say more that this negatively reflects on the whole state of Web3, where CoinGecko doesn't have to work on an Easter, when Sepolia Etherscan did not work for 3 days, thus preventing us from creating bonds. That's a true story. That's why we created it so late yesterday, because it just didn't work. Etherscan didn't work. Today it works with some like delays and stuff. So it's crazy. And when I'm, for example, trying to figure out exactly, like, LP stands for liquidity pair, that's coming from a DEX, right? Like from V2 DEX, like SushiSwap or Uniswap. when you try to understand exactly how LP works, you won't be able to find it either. And it seems like it's either done on I don't know why. Like, is it a conspiracy or something? But that's the biggest reason I think why we're not moving far with Web3. Is those fucking VCs either they're like on purpose trying to move down all the articles of those who actually describe how this how certain protocols work, or the founders themselves don't have the best interest in mind from the users. I don't know what this is. It's hard to believe that if you're building a Web3 project, why wouldn't you expose as much information as possible to the users if you rely on users' coordinated action, which is essentially buy and hold at the end of the day? Like, if you remove all the fluff, you need to buy and hold. But you need to be incentivized to do that. It has to be an incentive to do that. Like in Bitcoin, for example, you buy and hold. Why? Because more people, like, if you remove all this fluff about like this and this, what happens is there's limited supply. More people find out about Bitcoin. More people buying it. Some people losing Bitcoin, therefore they need to rebuy it again. So as more people discover Bitcoin, they keep buying it. Since there's limited supply, the value is supposed to increase. That's it. Then we can also find the reasons, excuses, rationale, good, bad, why Bitcoin should be growing, why it's amazing. But at the end of the day, limited supply, more people discovering about it, massive inflation, and limited supply, right? So that's what's happening, and definitely fundamental value when it comes down to the cost of producing one Bitcoin due to halving, right? So that's the genius. For us, the genius needs to happen in a couple of ways, right? So we need to, with Ghost DAO, we need to, in my opinion, minimize this ratio, introduce our own ratio, which I will describe in some detail right now with equations. Hopefully, you're not going to get lost or hate me after doing this. Some of these equations will be presented as well, and the idea is potentially to write them out and then formulate the strategy around these coefficients. And that's going to apply just to one Ghost DAO. Then we have to do this for another Ghost DAO, which is going to be similar. And then we need to do a cross-chain Ghost DAO tokenomics through bridging, right? To move to this 4,4, right? So that's what we're dealing with. So what I'm saying is, like, if you have issues with the chain, with like running a ghost chain node, like, I don't know, hire somebody, like, figure it out, like, ask, like, by the way, if you ask ChatGPT, it's not going to help you, huh? Yeah, if you want to ask the Coca-Cola recipe of ChatGPT, it's not going to tell you, right? Because there's no article that talks about the recipe. So it doesn't know shit. It only paraphrases what we humans created already. So running a node, while a complex, daunting task to some of you guys, because some of you guys not technical, realize lots of us not technical. Lots of us learning this as we go. Lots of us are just learning, literally learning, right? So do not get demoralized. Ask questions. Just keep asking, keep asking, keep asking, keep asking. If you're tired of asking, don't get any responses, hire somebody to literally do it. It's not going to be that expensive. And don't ask them to run it for you. Ask them to explain it to you and learn. With this, that's going to be even more complex. Ghost DAO. So you need to understand how this works. You need to understand how this works. Okay, so how many people watching us? I just want to see, is it worth me selling people? Okay, so somebody, J&J just bonded. Nice job. Thank you so much. Ron Chin, how do you think that the uptrend market for the cycle has already ended and are we now in downtrend? So that's a beautiful thing about Olympus. So diving deep into Olympus DAO this week, we forgot one thing. When Olympus DAO launched, many people noticed that the price of Olympus had nothing to do with the market. It was completely uncorrelated. So the beautiful thing about Ghost DAO, if we have enough users, that's key. We need to have, if you have 3 users, it's not going to work. If you have enough users, that's what we're discussing. Like, we're going to be discussing strategy with the council. I think the council met yesterday, some parts of the council to discuss it as well. Like, if we are able to finally construct, as we're closer to the launch, the community, the core community, increase the core community of whales, who can be running multiple nodes, say 400, 500 nodes, right? Total. Boom. Like, that's a given. We just fucking run it. We know. We all understand how Ghost DAO works. We all understand what the economic policy is, which is purely decentralized. We all understand how this operates and what to do, and we all act on it. I don't see how we cannot build a better future. I just don't see how we can. All it takes, it does not take millions of users. It takes 1,000 people. And in crypto, probably less. You know, we described it. Tried before, like if you have 1,000 like true believers running nodes, understanding tokenomics, participating on calls, guys, like we just built a freaking nation, like literally a nation. We will probably be competitive with some smaller nations, like based on GDP, like based on the treasury size. If think about this, like if Olympus went up to 4 billion market cap, and I think they screwed up, like the basis was genius still, absolutely genius, so fucking like it's crazy. But I think they messed up practically a little bit. So let me describe what we could do different. I'll try to do it very fast. We don't have much time, and I don't want to bore you, especially on a Saturday, pre-holiday Saturday. And thank you so much for who's listening now. So, do you guys see it? Yeah. Okay. So there are a couple of formulas that we need to take into consideration. So, there's a eGhost and sGhost. We're not going to dive into details on this. Not today. That's a staken. But we do have eGhost, which is important. So instead of FATSA, I'll be using eGhost because that's the real name. So when we have a market cap is equal to eGhost multiplied by eGhost price multiplied by eGhost supply, total supply. Now supply increases with APY. The APY at this point today, I think it's either 0 or 69%. So it's either in effect, or if it's in effect, it's 69%. If it's not in effect, 0% right now. It will be turned on soon, but today it's one or the other. Now, what's the eGhost price? The eGhost will never be trading on a centralized exchange ever. Kraken, Coinbase, forget about it. It will be trading on DEXs such as SushiSwap, Uniswap. Now, on SushiSwap, Uniswap, what you have an interesting dichotomy: X times Y is equal to K. What the hell does it mean? Specifically, what it means is quantity on the DEX of DAI multiplied by quantity of the DEX of eGhost on that specific DEX. On a different DEX, therefore, it's going to be a different price. That is equal to constant K. This constant K is what defines the price. So what defines the amount of eGhost you're going to get for the DAI that you essentially bonded to the DEX. But that's just one formula. Another, even more genius formula that works together with Uniswap is quantity on the DEX of DAI divided by quantity on the DEX of eGhost. That's exactly what defines the price of eGhost. So the price of eGhost is right here, and it's defined by the DEX. So when you go ahead and purchase quantities of J&J Ghost Swap, I think it's already called Ghost Swap. We just don't want to do our own DEX, but we're going to be forking Uniswap v2 and SushiSwap v2 as legacy. Thank you so much. That's a great, yes, that's, we wanted to either call it Ghost Swap or Ghost DEX, one of those. So that's what defines price. So like these two formulas is what the DEX is. Simple, but genius. That's what it is. There are definitely lots of connotations, but this is what DEX is described as. Okay, now that's so cool. Now, so what? What do we have with this? Well, market cap could be inflated because the price is inflated. Thus, we're introducing the so-called backend, right? So we call it risk-free value. But risk-free value, the treasury consists of two things. It consists of reserve risk-free value, which is stablecoins, RRFE, and it consists of LP RFE. So LP RFE is the LP shares that the treasury gets. So far, we don't have that many LPs. We actually have 90% of LPs in the treasury, maybe even close to 100% of LPs in the treasury, but we didn't get LPs from the users yet because there are no LP bonds yet. There are two types of bonds. One bond in case of DAI, that's what's happening today, another bond in case of LP shares. Those are two different types of bonds. And we need to understand which bond to use when. That's important, and how much. So we get into understand this very, very, very slowly, very surely. This week we made significant progress, and we already applied the knowledge for the second bond. So what is RRFV? RRFV is simple. And again, you're not going to be able to find these formulas anywhere, like literally nowhere. So we probably need to like publish our own formulaic. Like every single article has mistakes, pretty significant mistakes in this formula, so it's important for us to. So what essentially RRFE, what's that equal to? It's just equal to the quantity on the treasury of DAI multiplied by the price of DAI, which is $1. So essentially it's just equal to quantity of the treasury of DAI. When it comes down to LP RFE shares, that is more complicated. The short version of it is 2 multiplied by K multiplied by LP in treasury over LP total. Okay? Why is it 2 root K and what the hell is K? K, remember the DEX? Booyakasha, that's where it's coming from. I can derive this formula exactly why this is done. Now I completely understand how it's done, but that's the summary. That's RFE. So to sum it up, that's equal to quantities of all the DAIs plus 2 root K multiplied by, we'll call this one LP share, right? So the LP share, the amount of LPs in the treasury compared to total number of LPs outstanding. Now, the reason why this is 2 root K, that's important. It's 2 root K because they assumed that 1 eGhost is equal to $1, which is simply not true. And that's simply not our goal. So we can introduce another value called market value. It's going to be a market backend, market value of the treasury. And that is going to be equal to QT of DAI, but we're going to mark up this value. It's going to be equal to 2 root K times square root of eGhost price times LP share. And if you think that this update is not like minimum, it's massive. Because square root of eGhost at this point of time, like let's assume our price is $1,500. Let's round this up to $1,600. Square root of $1,600 is 40. So this component needs to be multiplied by 40. Imagine what that will do to the backend. So if our price today is $1,560, right? For example, that's our price. And let's assume our backend is only $4.40, right? I think. But our market value is roughly $80. And now let's look at this. Let's look at the coefficient of 1560 to 80. If you guys, can do the math yourselves, essentially that could introduce some type of P ratio, not exactly, but some maybe book value ratio. So we're gonna like put more definitions and put more proper analogies. But this ratio of market cap to backend is equal to 20. We checked today in the morning, what's the P ratio of Tesla? The P ratio of Tesla is 140. The lower, the better. NVIDIA, I'm actually not sure how much NVIDIA, let's actually check. How much is NVIDIA's P ratio? NVIDIA P ratio is, let me see. Yeah, we need to make these comparisons. Wait, P ratio is unavailable, not possible. So last year it was 140. I'm not sure what is it today. Today it seems like 34. Oh, 34, interesting. Okay, so NVIDIA is 34. So this is Tesla. This is NVIDIA. And these fuckers are telling us that we are building a pyramid schemes. Come on. Like, I mean, of course, Coca-Cola will probably have some. The average S&P 500 P ratio today is roughly 26. Ours today, we didn't do any bonds yet. Like, we just started out. Like, we didn't do much. 20. The lower, the better. The lower, the better. The lower, it means that the risk, the less riskier the investment is. So if our decentralized system, of course, like that's not apples to apples necessarily. We need to create apples to apples type of metrics. But essentially, if we can create in a decentralized Web3 world, metrics that are better than a metrics from a Web2 world, I think that's what success is. And what Olympus did not do is they did not look at into these metrics. And I think That's what's going to be just to maybe like put a final argument. It seems to me that at the top of Olympus, the market cap was $4 billion. And of the top, their back end, which is discounted, has been $350 million. This is 4 billion and this is 350 million. And therefore, this ratio is actually not bad, but not necessarily very good. It's been 1 to 10, right? So like, let's call it P ratio. It's not exactly P ratio, but let's call this like whatever, like 11, right? Roughly 11. However, if they went with MV ratio, which is more close to reality, this number turns into, even for them, turns into $11 billion. And now let me ask you a question, G-Gens. If the market cap today trades at 4 billion, but the fundamental value of the backend is 11 billion, would you sell? Right? You wouldn't, because it's a discount, right? Like the P ratio here is 1. The P ratio here is 0.3. Unheard of. Absolutely unheard of. I'm not trying to say that the Olympus, like fell down because they didn't show this one metric. I don't think they optimized for it. They had the tokenomics, they had the tech. But remember what I said in the beginning? The common sense optimization was for something else. And we need just to switch this. So we need to use those tools, but switch the focus, switch the goals to make sure that they are properly aligned with what we're really trying to get. So we're not going to launch Olympus in the same exact way how it was launched. We need to launch it. We need to use those tools, tweak them around, make them optimal, blah, blah, blah. But the final goals need to be different, and thus the whole thing will be different. At this positive note, guys, you don't have that much time left for the bond, so please bond as much as you can if you want to, of course, because that's a massive discount. Once you bond enough, the bond will disappear. So first come, first serve. That's massive discount for you at this point in time, 5x. Hope you like it. The backend will be reflecting this very soon. See you guys next week. Have a good one. Bye.